Welcome back, and good morning, and you're watching Market Cafe on ET Now with me, Vinny Otiwala, along with me, Ankita Saxena as well. Thank you so much for tuning into Market Cafe. And Ankita, again, we're back to the red in the global markets as well, right?
Absolutely. Vinny, the pain in the banking sector just doesn't seem to be coming to an end now. Yesterday, it was the Credit Suisse that was bearing the brunt, and the shares of Credit Suisse on yesterday plunged to a fresh all-time low for the second consecutive day after Saudi National Bank, Credit Suisse's largest investor, said it could not provide any more funding. Now, the news came after the Swiss lender said earlier this week that it had found certain material weaknesses in their internal control over financial reporting. Now, trading in the bank's plummeting stock was halted several times throughout the morning. Now, the company shares ended the session down 24%, bearing some of its earlier losses after dropping more than 30% at one point. The concerns over a banking crisis pressured the broader market. The Dow Jones Industrial Average ended the day 280 points lower. The S&P 500 dropped 0.7%. NASDAQ Composite was the only one that was bucking the trend, eked out a small gain, rising 0.05%, largely flat, but ended the day in the green. The major averages ended the day well off the session's lows. European market, sea of red, cuts all across the European markets, of course, on the back of what was happening with the banking stocks deep in the negative territory amid the SVB global fallout and more bad news coming in from Credit Suisse. The Pan-European Stock 600 index provisionally closed 3% lower, with all the sectors in the red. FTSE and CAC down more than 3.5%. DAX was down 3.2%. So again, a day of red. Vinny, negative global handover coming in there. Tell us, so where's the crude at?
Absolutely. Ankita, before I go to the crude, let's just mark that flash because it's coming in on Credit Suisse. That is that they're to borrow around CHF 50 billion from Swiss National Bank, and they are to buy back OP core senior debt securities for up to CHF 3 billion as well. So keep an eye out on that one. That's the latest update that we're getting in over there as well, and we'll see how that moves in. But when you talk about crude, we're seeing that the oil slumped overnight, 5% fall that we've seen coming in at the oil prices overnight, and that is, when you look at the Brent crude oil prices, they are at the lowest levels that we're seeing coming in for the first time since 2021, below the $75 per barrel mark. Now, this is the fall for the third consecutive session that we're seeing in the Brent crude oil prices. Recent peaks was as much as $86 per barrel for Brent crude oil, and just now look at it, that was just on 6th of March, down 13% from those levels as well. So this is the worst that we're seeing coming in terms of the fall also since 2020. Now, obviously, why is that so? Because there is a fear of failure of the US banks that could spark financial crisis, and that would weigh on the fuel demand as well. Now, OECD inventory is at a 5-year average. When you look at it, the stocks at OECD stocks at around 2,851 MB at 18-month high as well. So yes, there is going to be concerns around that crude price as well. As of now, has slumped below that $75 per barrel mark, but do not forget that works out well for Indian companies. But nonetheless, crude also in the red this morning.
All right, Vinny, so we do see a sea of red all across. Let's quickly go across to the events that we need to keep an eye out for today, and we will be watching closely. The US jobless claims data likely to come out today. The ECB rate decision is going to come out today. Keeping an eye out for that, and we will be getting you all the details for that. Now, back home, of course, we have Glenmark Life, Aditya Birla Life, AMC, and SAIL that will hold a corporate meeting to mull over interim dividend. And besides that, we have Andhra Pradesh that will be coming out with its budget for 2023-24. These are the events that we will be keeping an eye out for. Vinny, what are the global headlines that made news overnight?
Absolutely, in just terms of global stories that we're talking out for, let's not forget, that obviously Credit Suisse, the update that you're getting in from there as well. And mainly we will be talking about that because it was a volatile day, especially coming in for the Swiss bank Credit Suisse, with its stock plummeting to a fresh all-time low. Now, the fall came on the back of reports at Credit Suisse, biggest backer Saudi National Bank has said that it won't provide further financial help to the bank. Now, trade in the bank's shares had to be halted several times as it made news lows. Remember, Saudi National Bank acquired 9.9% stake in Credit Suisse in 2022, but more importantly, the bank has been in focus in the last couple of days as it's announced that it had found material weakness in its financial reporting processes for 2022 and 2021. Let's go across to Harsh, who is here to explain us what this actually means. More details on this as well. Harsh?
Well, yes, Credit Suisse facing the heat today, stock down 20% plus, but over the last 1 year as well, the stock is down 75%. And over the last 5 days or so, the stock has tanked 40% as well, including today's 20% plus fall. So what we are seeing is pressure, and this comes obviously on the back of the bank clearly suggesting that there were material weaknesses in its financial reporting on Tuesday. The bank also reported that there have been withdrawals of 110 billion Swiss francs in Q4 alone of calendar year 2022. So that will continue to mount pressure on the bank. But when it comes to the Credit Suisse, suggesting, or rather the investors of Credit Suisse suggesting, they seem quite confident of the manner and the trajectory in which Credit Suisse seems to be progressing. Saudi National Bank, which owns around 9.9% stake, obviously can't increase stake due to regulatory limits, but has come out and suggested that they seem quite comfortable with the manner in which the bank is recovering. In fact, the dollar bonds of the bank have moved to distress level now, but the CEO has come out and made a few statements. He suggests that the bank is strong and have not overshot, or rather are well within all regulatory limits. What they are also suggesting is that the liquidity base for the bank is strong, and that material weaknesses referred to in the financial reporting controls have no impact on the financial results per se. He's also come out and suggested that there's a heightened attrition at the moment, but that's not surprising, and they're hiring from the market as well. And what they're suggesting is that the situation in the US with regard to bonds plunging is not comparable and factually has nothing to do with Credit Suisse per se. The fundamentals continue to stay strong. That's what's really come through.
Any bank which is, regardless of the size, if it is raising capital in the market, it sends a signal that it is trying to cushion itself, and it doesn't have sufficient capital if there were a credit risk to come about, right? And this is a perfect recipe at this time. Europe has moved from a negative interest rates to now just about in the 2.5% to 3% range. So I think that is bound to create ripples. And I think, of course, market is not convinced that your capital requirements are done. When a CEO comes out and says, we are sufficiently capitalized, that, of course, rarely is the truth, at least at the time that, when the statement is made.
There are many times where companies say one thing and the fundamentals are actually different. Now, you have, for instance, you have the CEO of the branch here in the States saying that we're fine, while the market is suggesting otherwise. So it's a little too early in the game. I guess we'll just have to wait and see as to whether or not the market is right or Swiss Bank is right.
And well, staying with the banking crisis, after the Swiss National Bank said that Credit Suisse can access liquidity from the central bank, Credit Suisse announced it will borrow up to $53 billion under a covered loan facility and a short-term liquidity facility.
From one crisis to another, reports suggest that the cash-strapped Silicon Valley Bank is now exploring bankruptcy as an option to seek protection and sell assets.
And UK Chancellor Jeremy Hunt has said that the UK economy will avoid a recession this year as outlook witnesses improvement. On the underlying growth front, he adds that they expect to grow 1.8% in 2024.
Shares of Snap and Meta rose on the back of a Wall Street Journal report which said that the short-form video app TikTok faces a potential ban in the US if parent company ByteDance fails to comply with the Biden administration's propositions. Investors' optimism lifts stock of Meta and Snap in anticipation that the TikTok ban would help these apps to regain the lost users.
And amid the global turmoil in the broader financial system, Goldman Sachs has lowered its 2023 economic growth forecast for the US, citing a pullback in lending from small and medium-sized banks. The brokerage believes smaller banks will attempt to preserve liquidity in case they need to meet depositor withdrawals, leading to a substantial tightening in bank lending standards.
Payment processing giant Stripe has raised $6.5 billion at a $50 billion valuation, which is reported to be about 47% lower than its 2021 valuation of $95 billion. The company said it doesn't require capital to run business and rather it will use the proceeds to provide liquidity to employees.
And well, the current turmoil will not be as bad as the global financial crisis, believe market experts. Shankar Sharma sees good opportunity in fixed income, while Sandeep Tandon is betting on value themes like metals, power and PSUs. Now, they believe that India is much better placed despite the volatility. Listen in to what they had to say.
My belief is you're not going to get a broad bull market. I don't think any of us should hold out hope that we are going to see a broad bull market in India, that is, anytime soon. We are going to see very patchy markets in which a reasonable part of the markets will be flat or even down, while small pockets of stocks, whether in the Nifty or below the Nifty, will be doing well. And that's really the skill of your investment acumen will be tested in this year.
Any such corrections, are seen or should be seen as an opportunity to invest. And in 6 months, whether it is 3 months, 6 months, nobody knows. But definitely these are very attractive points. India's story continues to remain. In fact, our interest rates are not in a dangerous territory. In fact, as inflation settles down, which I think is a matter of time, whether it is 3 months or 4 months, I think we have already seen the peak, and slowly you start seeing only coming down. There could be case made for Indian interest rates coming down. Whether it is again 6 months, 12 months, I don't know. But Indian economy is on a solid path. And slow down of 1 or 2 quarters always happens.
If I have to look at 2023 now, yes, it will be volatile, but if we can say with good amount of confidence, the top is in place. So answer is big no. Okay, because the characteristic from a behavior perspective, what we look at from a various conditions and euphoria which has happened across all the street has not happened. Okay, which means that if I have to look at larger perspective, you will see again all-time high as early as maybe in the last quarter of 2023 or maybe beginning of first half of 2024.
So Indian market is actually a wealth creating market. So you should not be perturbed by so much of this volatility because that part and parcel of equity investment. But if you are a long-term investor, definitely equity as an asset class will outperform bonds. And I feel that this is what one should look at. Secondly, India is in a sweet spot with respect to the GDP growth, with respect to the equity market, with respect to flows.
Broadly over time, equities will do well. And secondly, that broadly over time, if you buy on fear, which is not directly associated with you, you will mostly do better than other markets where their fear might be more valid up to a point. But I don't see the connection between US banking sector and our banks at the first level. Like the market is down less than 0.9%. If you look at it year to date, the market is down like 4-5%. And this is after absorbing a very big issue, which at the end has been handled well, which is from their point of view, the Adani issue.
Very unlikely that anytime soon we are going to ZIRP, which is zero interest rate policy in US. It's very unlikely that RBI would actually come with dollops of liquidity anytime soon, and which is why the tightness in the market would sort of sustain very likely, even though inflation's sort of peak, as you said and alluded to, is very much behind us. It's just that the scare of it, of its return is so much that central bankers, Nikunj, would rather be circumspect, for throughout 2023 and not cut rates, or, perhaps, we'll pause on QT, but we'll certainly not do QE. And all of that doesn't augur well for equity, Nikunj, which is why, I'm afraid that even today is meant, but I continue to say that stay out, be underweight general equity and be extremely cautious of small and mid cap.
In SVB's case, we saw Fed had to take few days to intervene. So put all these things together, better regulation, quicker responses, much diversified this deposit base. I don't think so. SVB kind of things will happen in quote unquote regulated and supervised sector of finance in India.
It has implications for policy going forward. As Andrew just mentioned, obviously, we've seen a significant rally in US bonds. Markets have pared back, tightening expectations to the point where now there's only a 1 in 2 chance of priced in for a Fed hike at the next FOMC meeting. And it seems like an overdone reaction, but now there's a real chance that the Fed will pause. So I think amidst all this volatility, the Fed is also trying to gauge the market reaction. We've had substantial weakness in European equities. Today, we've had, or will be seeing that in the futures. We've had we've had some weakness in US markets, but not significant. Bank stocks certainly came under a lot of pressure.
That's all the big voices, market veterans, talking about how should we be navigating this volatility that we're seeing. But on that note, we're going to slip into a very short break. Don't go anywhere. We'll be back with more domestic updates.
Welcome back. You're watching Market Cafe with me, Ankita Saxena, and with me is Vinny Motiwala. Now we'll quickly move on to news coming in on the domestic front. India's merchandise trade deficit in February stood at $17.43 billion. Imports and exports each saw a dip of over 8% on an annual basis in the month of February. Now, exports have now contracted for the third straight month, mirroring an anemic manufacturing activity.
And keep it going. And speaking about trade, the government is expected to release the new 5-year foreign trade policy by the end of March, with a view mainly to promote the country's outbound shipments of goods and services. Meanwhile, the Commerce Ministry is also targeting to take the goods and services exports to $2 trillion by 2030. Let's go across to my colleague Sameer Dixit, who's gotten more details and update on this. Sameer?
The government released the trade data for the month of February 2023. The import as well as the export continues to show the declining trend as compared to year-on-year basis. For the month of February 2023, the export stood at $33.89 billion, whereas for Feb 2022 it was $37.15 billion. Similarly, when it comes to import, the figure for February 2023 stood at $51.31 billion, whereas for Feb 2022 last year the import was $55.90 billion. So there also a declining trend is clearly visible. For the trade deficit for the month of February, it stood at $17.43 billion as compared to year-on-year basis. Last year, it was $18.75 billion. So, despite global headwinds, the government says that the export momentum is there, and in the coming months, the export may scale up. But government is pretty much sure that they will be able to surpass the target, the export target for the financial year 2022-23, which is $750 billion. And a major contribution is likely to come up from the service export, which is growing at a good pace. Government hopes that the $750 billion target will be easily achievable, and the service export will play a very crucial role in this. But as WTO indicated that the global trade could be somewhere to 1% or less than 1%, even to less than 1%. There, this export data, government says that it shows a healthy sign, and recovery might be there in coming months. In addition to this, the government also shared the smartphone export figures. till January 2023, the smartphone export stood at somewhere around 67,500 crore rupees and is likely to achieve a mega milestone by the end of this FY. So overall, government hopes that despite the global headwinds, the export figures may scale up, and in addition to this, the new foreign trade policy is also being worked upon, and which is likely to be released by the end of this month, that is March 2023.
And well, moving on, we all know that real estate in Mumbai is an expensive position, and we Mumbaikars know that better. And recently, Bajaj Group's promoter Neeraj Bajaj managed to buy a triplex flat for a whopping 252 crore rupees, making him the owner of India's most expensive apartment. And the flat is under construction, building, and will be completed by 2026. My colleague Anurag Shah went down to Valkeshwar near Raj Bhavan, where the building is, to bring you a sneak peek into what the country's most expensive apartment is likely to look like. Let's take a look.
Mumbai's luxury residential real estate market is on roll, and Mumbai has just witnessed most expensive luxury real estate residential deal. Neeraj Bajaj, chairman of Bajaj Auto, has bought a triplex penthouse in 252 crore rupees deal. That is most expensive real estate deal. For this deal, Neeraj Bajaj has paid 15 crore rupees as a stamp duty. That is in a super luxury residential complex, which is Loda Malabar at Valkeshwar near Arabian Sea. It is a 18,000 square feet triplex penthouse. So according to this, the per square foot rate is around 1,42,000. It's an under construction building which will be completed by 2026. So according to real estate expert, the prices may go up also. Presently per square foot price is 1,40,000, and for this it has 15 crore stamp duty has been paid.
Okay, that's obviously the one that we're keeping an eye out on in terms of the new developments coming in Mumbai. But in a recent interview, my colleague Tamanna caught up with S.K. Ghosh, the chief economist advisor at SBI, on the Fed's rate hike trajectory and the underlying issues on the current CPI basket as well. He also speaks about how the Indian banking system stays strong amidst the volatility. Let's go across and listen to the slice of this conversation.
I think there are serious methodological issues with the current CPI basket. Unfortunately, these issues have not been addressed for whatever reasons, and that is actually also playing a spoil sport in these CPI numbers. But even if I keep aside and assuming that all is good with the methodology, my sense is that after some point of time, given the fact that monetary policy works with long and variable lags, we may have to give time to the past rate action to percolate through the system to have a meaningful impact on demand. If we take the example of Fed, the Fed actually has been trying to push up inflation so that the demand declines and then it can pull down inflation, but it has not succeeded. The past rate hikes are still working through the system, and maybe it may be a better idea to allow them to work through the system and then see where does the inflation stand. Otherwise, what is going to happen is that suddenly now we are seeing a constellation of forces which is actually pulling up the credit growth a little down, and suddenly we could see that all these constellation of factors working together to have a sharp impact on the future growth trajectory.
And moving on, SJVN has entered into an MOU with Indian Oil for the formation of a joint venture for the development of renewable energy projects. My colleague Prakash Priyadarshi caught up in an exclusive conversation with SM Vaidya, who's the chairman of IOC. Listen in to what he had to say.
हमारा जो renewable energy, whatever targets we have set for ourselves, this majority of that will come from this. And this particular joint venture, what we are talking, will have a lot of renewable energy forms in its basket. It will have solar, it will have wind, it will have hydro, it will have green hydrogen and green ammonia. So the breakup of each and every one of them, we will detail it out later. But the idea is that this JV that is getting formed today, what we have announced today, the intent, will have a lot of scope in our journey towards renewables.
So what would be your capacity addition target? Let's say about solar, wind.
I think I don't have the numbers, but you already given the numbers. I think 35 gigawatt. That is what we are planning in the 2030 space. So this MOU will certainly play a major role in achieving that 35 gigawatt renewable target.
What would be investment target, because it requires huge sum?
Investment target is 5 crore rupees by the year 2050. This will not be only for this. 5 lakh crore rupees for not only for this but for all the forms of energy, for making Indian Oil a 12.5% energy supplier in the country, which is currently 9%.
Other than this renewable energy planning, considering the growing demand of energy to meet energy requirement of the country, what would be your future strategy in terms of your traditional fuel?
So our future strategy is two-pronged, ensuring the current supply from the core business that happens, because we want the energy transition to be fair, just, and there should be an energy security and affordability. So current forms of energy will continue. At the same time, we are making headways into the newer forms of energy, that is renewables, biofuels, green hydrogen, so that as and when the time comes, we will ramp up those ones. But we have to ensure the energy security of the country is maintained. And as Indian Oil, we pride ourselves as the energy of India. It is our prime responsibility to see that the energy requirements of the country are met.
Okay, on that note, let's just slip into a very short break, viewers. Don't go anywhere. We'll be back with more stock-specific update after this break.